Let's go through an example of a capital lease from the lessee perspective. I'd like to go through a 2-year example so we can go from start to finish, and let's use the same asset for all the examples. Let's assume that lessee company is going to lease an asset on January 1st, 2020. The asset is a fair value of $1,000. There's going to be a $100 terminal payment, either a residual value or a bargain purchase option as we go through the variations of this example. And the lessee and lessor both use a 10% discount rate. Payments will be at the end of each year. The asset has a 3-year useful life and an expected salvage value of $10. Let's start by assuming the terminal payment is a guaranteed residual value. First, we need to compute the lease payments. We start with the fair value of the asset, subtract the present value of that $100 residual, discounted at 10% for 2 years. That gives us the present value of the rental payments, and for a 10% 2-year ordinary annuity, this implies a rental payment of $528.57. Now we have to address the question of whether or not this is a capital lease. And again, we have 4 criteria. Is there a transfer of ownership? No. Is there a bargain purchase option? No. Is the lease term greater than 75% of the asset's useful life? No. 2-year lease, 3-year asset life. Finally, is the present value of the minimum lease payments 90% or more of the asset's fair value? Now again, the minimum lease payments includes the periodic rental payments, any guaranteed residual value, or any bargain purchase option price, or any penalty for failure to renew. So in this case, looking up at that computation of the lease payments, the present value of the guaranteed residual is $82.64. The present value of the rental payments is $917.36, total $1,000, so clearly that is more than 90% of the asset's fair value. So yes, this is a capital lease. Okay, let's go ahead and capitalize this lease. First, we record the inception on January 1st, 2020. We're going to go ahead and record a leased asset at the present value of the minimum lease payments, and we record a lease obligation for the same amount. Now those two accounts are going to go their separate ways. The leased asset will be depreciated or amortized over the term of the lease. The lease obligation will be paid off over the term of the lease. At the end of the first year, the lessee makes their first lease payment of $528.57, and as is always the case with installment debt like this, we're going to split that payment between interest and principal. Interest will be 10% of the lease obligation balance. The remainder goes to pay down the lease obligation itself. Next, we need to go ahead and depreciate the leased asset. Now the rules for depreciation of a leased asset are in the numerator. We're going to start with the cost of the leased asset, $1,000, and if we're going to be returning the asset, if there's a guaranteed residual value or an unguaranteed residual value, we're going to depreciate it down to any guaranteed residual value over the life of the lease. So we're going to take $1,000 minus the $100 guaranteed residual, so it's $900, and we're going to amortize that or depreciate that over 2 years, $450 per year. At the end of 2021, we do the same thing. We write our second rent check for $528.57. Some portion of that is interest expense. Now again, the lease obligation started at $1,000. We paid off $428.57 at the end of 2020, which means that for 2021, the lease obligation balance is $571.43. So interest expense, $57.14. The remainder of that payment goes to pay down the lease obligation. And we take another year's worth of depreciation expense. Now at this point, we have a remaining lease obligation balance of $100. That represents the guaranteed residual value. We have also depreciated the leased asset down to that guaranteed residual value of $100. So it's simply going to be a matter of satisfying the lease obligation by surrendering the leased asset. So we're going to get the leased asset off the books, we're going to get the accumulated depreciation off the books, and by doing so we satisfy that lease obligation. Now this was a guaranteed residual value, which means that if the asset isn't worth the stipulated amount of $100, we have to write a check to make up for the shortfall. So if that's the case, we'll go ahead and write a check for whatever the shortfall is and record that as a loss on the lease residual value. Okay, let's go ahead and go through the exact same example, but now let's assume that that $100 terminal payment is an unguaranteed residual value. We would go through and compute the rental payments in the exact same fashion. Again, in terms of computing the rental payments, whether it's guaranteed or unguaranteed doesn't really affect this computation. Now, in reality, of course, an unguaranteed residual value is more risky for the lessor, so they may demand a higher rate of return. So instead of using a 10% implicit rate of return, they might demand an 11% rate of return. So there might, so saying that the residual being guaranteed or unguaranteed is irrelevant is not entirely correct. But assuming that we're going to be using the same discount rate, then it is. It doesn't matter whether it's guaranteed or not as far as computing the rental payment is concerned. So again, we have to go through the steps of deciding whether or not this is a capital lease. Again, does the lease transfer ownership? No. Is there a bargain purchase option? No. Is the lease term 75% or more of the asset useful life? No. Is the present value of the minimum lease payments more than 90% of the asset's fair value? Now again, the minimum lease payments includes the rental payments. The rental payments have a present value of $917.36. So yes, that is more than 90% of the asset's fair value, so this is a capital lease. So we'll go ahead and record the inception of this lease, and again, we're going to record the leased asset and the lease obligation at the present value of the minimum lease payments. In this case, that does not include that unguaranteed residual value. Now, if you think about it, in the previous example, we started with a lease obligation of $1,000. That included the present value of the rental payments and the present value of the residual. So when we got to the end of the example, that residual value of $100 sort of popped out as the ending balance in our lease obligation account. In this case, that $917.36 is the present value of the rental payments, but does not include the residual. That means that once we pay off those two payments, the lease obligation is going to be down to zero. So again, at the end of 2020, we write our first check for $528.57. Interest expense, 10% of the lease obligation. The remainder goes to pay down the lease obligation. For depreciation, again, if we're going to be returning the asset as we are, we depreciate it at cost, $917.36, minus any guaranteed residual value, in this case 0, over the term of the lease. So $917.36 minus 0 over 2 years is $458.68. In 2021, we do the same thing again. We write another check for $528.57. Interest expense, $48.05. Again, our lease obligation started at $917.36. We paid off $436.83, leaving us with a balance of $480.53. The remainder of that payment goes to pay off the lease obligation. Now, in this case, we've got a little bit of a problem. The lease obligation balance after the 12/31/20 entry was $480.53. We just paid off $480.52, so there's still a penny left in that lease obligation account. So here we have a little bit of a rounding error just due to the computations of the present value and the payments. So we need to go ahead and sort of fudge those numbers a little bit, add a penny to the interest expense, take away a penny from the interest expense, and add a penny to the debit to the lease obligation. In any event, we take another year's worth of depreciation expense, and at this point, the lease obligation has been depreciated down to 0. The lease obligation has been paid off down to 0. The leased asset has been depreciated down to 0. So all that matters is basically we have to return the asset, getting the leased asset and its accumulated depreciation off the books. So we go ahead and credit leased asset and debit accumulated depreciation. Now, if the asset is not worth the expected $100, then that's not the lessee's problem. Again, from the lessee's perspective, if the residual value is unguaranteed, it might as well not even exist. If I can't be held liable for it, I don't care what it is. Okay, last iteration. Let's go ahead now and assume that that $100 final value flow is a bargain purchase option. And again, the first thing we do is go ahead and compute the rental payments the exact same way they were done before. Next, we decide whether or not this is a capital lease. First question, is there a transfer of ownership? Still no. Is there a bargain purchase option? Yes. That means this is a capital lease. Lease term, just for completeness, 75% or more of the asset useful life, still no. The present value of the minimum lease payments. Now, although we know this is a capital lease, we still have to make this computation because that's the amount that we'll capitalize as the amount of the leased asset and the lease obligation. So at the inception of the lease, we're going to capitalize $1,000. Again, that's the present value of the minimum lease payments. The rental payments, present value $917.36, plus the present value of the bargain purchase option, $82.64. We make our end-of-year payment, and we record our end-of-year depreciation. Now, in this case, we're going to be keeping the asset. Again, we assume the bargain purchase option will be exercised. If we're going to own the asset anyway, we depreciate the asset as though we already own it. So cost minus salvage over useful life. So $1,000 cost, that's the leased asset debit, minus the expected salvage value of $10, so $990, spread over the 3-year asset life. 12/31/21, same thing as before. We make our second payment, splitting it between interest and principal, and we take another year's worth of depreciation expense. Now at this point, the lease obligation balances down to $100 again, which represents the bargain purchase option price. We're going to exercise the purchase option, writing a check for $100 and thereby paying off the last of the liability. Now, the last thing we have to do is we just need to sort of rename some things on our balance sheet. Right now on our balance sheet, we have a leased asset and we have accumulated depreciation leased asset. We need to go ahead and basically remove the reference to those being leased assets and make them just regular owned assets. So we take away the leased asset and replace it with just an asset, whether this is a machine or equipment or what have you. And the same thing with accumulated depreciation.